Welcome to vTalkInsight, Risk Sentiment Daily for January 14th, 2026. Global equities are hovering near record highs, yet policy and geopolitical risks are building underneath the surface. Today we unpack how that tension between strong fundamentals and rising tail risks is shaping market sentiment and risk appetite. Risk sentiment today looks two-way but still broadly constructive. Equity indices in the United States and abroad are near or at record levels, yet the latest session saw a small pullback in the S&P 500 and a modest uptick in implied volatility. A daily decline of only a few tenths of a percent, alongside a VIX reading just below the mid-teens, suggests investors are trimming risk at the margin rather than exiting, while keeping some protection in place. Underneath that price action, strong macro and micro fundamentals continue to support a constructive backdrop for risk assets. Robust economic growth, resilient consumer spending, and accelerating productivity are feeding through into corporate results. Early earnings reports show roughly mid-teens profit growth for S&P companies even with flat revenues, pointing to margin expansion, much of it linked to technology and AI-driven efficiency gains. Bank loan growth has picked up to mid-single digits year-on-year, capital markets pipelines remain busy, and sectors tied to capex, energy, and travel are reporting healthy demand. Set against this, several heavy headwinds are moving closer to the foreground. Equity valuations are stretched, with the S&P 500 trading around the low 20s on earnings and embedding ambitious, mid-teens growth expectations beyond the largest tech names. At the same time, policy and geopolitical risks are rising, from political pressure on the Federal Reserve and investigations into its leadership, to more interventionist proposals on credit and payments, to elevated tensions in key energy regions. Compared with the cautiously risk-on tone described last week, those tail risks are now more clearly reflected in higher expected volatility, even if headline indices remain close to their highs. The first major bullish driver is an AI-driven productivity and earnings boom that is still unfolding. Recent data point to U.S. productivity growth running near 5%, with unit labor costs declining. For the S&P 500, real revenue per worker has risen by about the mid-teens since late 2022, meaning companies are generating substantially more output without a commensurate rise in wage costs. That dynamic is underpinning profit margins and helping explain why profits are growing in the mid-teens even while top-line revenue is largely flat. Semiconductors and the broader AI ecosystem sit at the heart of this story. TSMC just reported roughly 20% year-over-year revenue growth, driven by surging demand for AI chips and strong premium handset sales in China, and expects AI-related demand to sustain growth through at least 2026. NVIDIA is entering a new product cycle with higher memory and processing density, while Intel and AMD have both been upgraded on expectations of robust data center and AI-related demand. Together, these developments reinforce the view that AI capex will remain a powerful earnings engine for leading tech and hardware names. This AI-driven productivity and earnings boom has broad market implications. It supports higher sustainable growth, cushions margins against wage and cost pressures, and underpins risk appetite for both equities and high-yield credit linked to the capex cycle. However, there are clear fault lines. Not all chip and software vendors are benefiting equally, as downgrades of firms exposed to legacy or non-AI demand, as well as rising data center power costs and growing local resistance to new facilities, highlight. Investors are watching whether productivity and earnings gains remain concentrated in a narrow set of AI leaders or continue to diffuse across sectors and regions over the coming quarters. The second supportive force is broadening market breadth beyond megacaps. Leadership is rotating away from an exclusive focus on the largest tech names toward a more diversified set of winners. Market breadth has improved as profitable small caps, international equities, materials, and industrials participate more fully in the advance. Recent performance shows small cap and cyclical stocks outperforming megacap tech even as rates have drifted higher, suggesting confidence in a broader economic expansion. Cyclicals, banks, and energy are central to this broadening story. U.S. bank loan growth has accelerated to the mid-single digits, and large banks report record trading revenues, solid net interest income guidance, and expectations for a third year of outperformance supported by steeper curves and still benign credit conditions. Energy equities are regaining momentum, with a high share of index constituents trading above medium-term moving averages and a meaningful proportion at new highs, while integrated majors have delivered risk-adjusted returns that outpace the broader market. Internationally, selected emerging equity markets, including China, are seen with double-digit upside potential on the back of improving earnings expectations and possible policy tailwinds. Broader leadership reduces concentration risk and changes the opportunity set. Lower correlations and greater dispersion across stocks are expected to persist, which tends to create a more favorable environment for active managers relative to passive index exposure dominated by a few megacap names. There are caveats. Earnings growth for the largest tech names is decelerating, shifting the burden of delivering the index's high profit growth assumptions onto this broader cohort, and some sectors such as financials still face political and regulatory headwinds. How sustainable this broadening proves to be will be shaped by upcoming earnings, particularly from banks, industrials, energy producers, and non-U.S. markets, now moving into the leadership role. The third constructive driver is disinflation and the prospect of eventual Federal Reserve easing. Recent core inflation readings have consistently come in slightly below expectations, with month-on-month gains around 0.2 and annual core inflation in the mid-2s. Headline inflation remains above the Fed's target, but the trajectory is downward, and projections suggest price growth could approach 2% by the end of 2026. That backdrop has been enough to prompt a positive reaction in equities and a mild decline in Treasury yields following the latest data. Markets interpret this disinflation as paving the way for rate cuts, just not in the very near term. Bond yields fell on the softer inflation print, and expectations have shifted toward modest cuts later this year rather than an extended higher for longer stance. That said, several voices now see the first cut pushed back from the first quarter toward the second half of the year, citing persistent inflation and still firm labor markets. Market pricing does not reflect aggressive easing, with limited cuts expected before mid-year and yields recently holding in a relatively tight range. For risk assets, this combination of disinflation and eventual, measured easing is broadly supportive. It lowers the perceived risk of a renewed tightening cycle, underpins equity valuations, and supports demand for credit, particularly in high yield where growth and AI-linked capex are expected to keep default risk contained. The main risk to this driver is that inflation has now run above target for 5 consecutive years, and some forecasts point to renewed upward pressure from factors such as energy and fiscal expansion. If that materializes, the scope for easing could be smaller and later, leaving risk assets more vulnerable to shifts in the rate path. On the bearish side, threats to Fed independence and policy credibility are becoming a key concern. A Department of Justice investigation into the Fed chair, alongside political efforts to scrutinize and potentially reshape the central bank, has raised questions about its autonomy. These moves sit within a broader context of more populist and interventionist economic proposals, from aggressive fiscal packages to targeted caps on credit card rates and tighter regulation in specific sectors, all of which increase policy uncertainty. So far, market pricing suggests investors are still largely focused on growth and earnings, with relatively narrow risk premia for policy uncertainty and no outsized safe haven bid for the US dollar. However, other signals tell a different story. Gold has outperformed and is seen by many as the primary geopolitical and institutional hedge, with strong demand from central banks and investors looking to diversify away from dollar exposure. Expectations for higher volatility are also building, with market participants increasingly citing political uncertainty and potential policy mistakes as drivers of larger market swings ahead. If concerns over Fed independence were to intensify, the macro consequences could be significant. A perception that inflation-fighting credibility is eroding might push term premia higher, steepen the yield curve, and weaken the dollar as investors demand greater compensation for holding long-dated U.S. assets. Legal developments, including court decisions that either constrain or enable political influence over the central bank, are therefore important catalysts to monitor. The key question is whether current political pressure remains noise around the edges or evolves into a structural challenge to the policy framework that has underpinned global markets for decades. Another major headwind is elevated valuations and yield shock risk. The S&P 500 is trading near all-time highs at roughly 22 times earnings, with pricing that assumes 14 to 16% annual earnings growth across the market, not just in the largest tech names. Such ambitious assumptions leave little room for disappointment. High expectations for earnings surprises in financials and other cyclicals mean that even beats can be greeted with profit-taking if guidance or mix is less favorable, as seen in the mixed reaction to recent bank results. Valuations are also vulnerable to any sharp move higher in long maturity yields. A key tactical risk flagged by many investors is a rapid rise in long and treasury yields, driven by a combination of persistent inflation, strong growth, and concerns over fiscal deficits and bond supply. Developments in Japan add to this risk. Long-term Japanese government bond yields have reached multi-decade highs, and speculation that the Bank of Japan may need to accelerate rate hikes could have spillover effects on global bond markets and relative demand for treasuries. When expensive equities meet the possibility of a yield shock, the repricing can be abrupt. Markets are currently in a holding pattern, with long-dated bonds widely under-owned despite attractive real yields, suggesting scope for a shift in allocation if growth or inflation surprises push investors back toward duration. In this environment, the equity index becomes increasingly sensitive to negative surprises on earnings, policy, or inflation. How the next leg of the bond market story unfolds will be critical for the sustainability of current multiples. The third bearish driver is geopolitical tensions and energy supply risks. Conflicts and political uncertainty in key producing regions such as Iran and Venezuela are feeding risk premia into oil and raw materials, with West Texas Intermediate and Brent both trading comfortably above the low 60s. A record net short position in oil futures, combined with rising geopolitical risk and steady demand from major importers like China, creates conditions where any supply disruption or hoarding could trigger a sharp price spike. Beyond energy, geopolitical tensions are broadening. Escalating U.S. interest in regions such as Greenland, fragile ceasefires, and renewed doubts over the durability of trade agreements with China all point to a more fractured global landscape. Europe is responding with increased defense spending and industrial mobilization, while major defense companies invest heavily in supply chain independence and stockpile critical materials. These shifts support defense equities, but also underline the rising cost and complexity of global security. For macro risk sentiment, these geopolitical and energy pressures cut both ways. They create pockets of strong performance in energy and defense, and can support certain frontier or reform stories, but they also threaten higher headline inflation, weaker real incomes, and renewed volatility. Safe haven demand has already shown up in stronger gold prices and, at times, in the US dollar relative to other major currencies. The evolution of these tensions will be central to whether the current constructive regime persists, or gives way to a more classic risk-off environment driven by higher energy costs and trade disruptions. To sum up, risk sentiment is two-way but still broadly constructive. An AI-driven productivity and earnings boom, wider market breadth, and a disinflation trend pointing toward eventual Federal Reserve easing continue to support appetite for risk assets. At the same time, mounting threats to Fed independence, stretched valuations vulnerable to any yield shock, and persistent geopolitical and energy risks are keeping tail scenarios very much in play. The balance between these forces will likely be set by incoming earnings, inflation prints, and policy headlines over the weeks ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.